Have you been following the news on the housing market lately? If you have, you might be aware that the situation has been dire, with prices plummeting nationwide. But did you know that some cities are experiencing far worse crashes than others? In fact, during the 2008 crash, prices in some regions fell significantly more than the national average of 27.3%. And now, with the current market crash, the situation is becoming even more severe. So, which cities are most at risk, and what does this mean for investors? In this video, we'll explore the scariest Washington housing market crash, which is just getting worse, and examine the effects on real estate across the country. You won't want to miss it as we take a closer look at the data and analyze the potential implications for the future of the housing market. So, let's get started. As the Shiller Index flips and home prices plummet nationwide, you might be curious as to which cities will experience the most severe impact. It is widely known that the real estate market is heavily influenced by regional factors, and throughout history, there have been significant discrepancies in the severity of crashes depending on location. For example, during the worst real estate crash in recent history, which occurred in 2008, prices plummeted by 27.3% across the country. To provide some perspective, this meant that a house that cost $250,000 during the peak of the bubble would cost $182,000 post-crash, a significant discount, but not necessarily a fatal blow. However, people often recall the 2008 crash as being far worse than this national average suggests. This is because this number fails to capture the true extent of the damage that occurred in many major cities throughout the United States. In fact, numerous regions experienced collapses that were significantly more severe than the national average. The most extreme example of this was Las Vegas, which saw prices surge 233% from January 2000 to July 2006 before crashing in the years that followed. While we are discussing the past, it is worth noting that in 2008, the market began to crash after a full year of parabolic growth. The downward trend persisted until March 2012, resulting in almost 6 years of price declines. During this time, the Las Vegas market crashed by 62%, meaning that the same $250,000 house mentioned earlier would cost just $95,000 post-crash. This is a massive difference when compared to the national average, and serves to highlight the importance of considering regional factors when analyzing the impact of real estate crashes. By taking a closer look at individual inflated markets during a downturn, we can see that the situation can vary greatly from city to city, and the national average may not give a complete picture of what is happening on the ground. With this understanding in mind, let's examine the current market crash, which presents a dilemma for investors. The Federal Reserve is engaging in aggressive monetary tightening, and Bank of America predicts 0% returns from stocks next year. It has never been more challenging or essential to restructure one's portfolio. However, there are alternatives that can provide a reasonable solution, such as alternative asset classes. Both JP Morgan and BlackRock have recently announced their intention to deploy such strategies, and one platform that seems particularly promising is Masterworks. Masterworks offer access to top alternative asset classes, such as physical paintings from legendary artists like Picasso. According to UBS, the ultra-wealthy are spending double what they did last year on fine art as part of their diversification strategy, and Masterworks claims that investing in fine art is a natural inflation hedge. The platform buys fine art and qualifies it with the SEC, splitting it into shares for investors. This is not crypto or NFTs, but real, tangible assets. When it comes to the housing market, there are significant variations from one city to another, despite a national Case-Shiller decrease of only 2.3%. Numerous markets in the United States are experiencing what many refer to as the post-2020 boomtown, where a combination of variables has resulted in skyrocketing prices. However, as the situation begins to shift, there is already a significant deviation from the national average, with Seattle leading the way, as it did in 2008. After the crash of 2008, Seattle was a region rife with speculation and tremendous price growth, with home values increasing by 316%. The chart shows that the growth rate was already getting out of hand before 2020, and as evidenced by the example, it goes parabolic. From October 2021 to May 2022, prices jumped by 20%, which is unheard of in the real estate world. The combination of unprecedented demand and enormous inventory is a significant factor. During the period following February 2020, houses in Seattle were being sold within a median time of 7 days, which was among the lowest numbers in the country. The inventory levels at that time were also low, which was the reason why houses were being sold quickly. In fact, the inventory shortage was so significant that Seattle saw an 85% reduction in the number of houses for sale, which was a record-breaking figure. This shortage of houses had a direct impact on the price of houses, which is a basic principle of supply and demand. While this may not necessarily indicate a housing bubble, it is important to note that the Seattle housing market bubble was preceded by the Seattle tech bubble. Many high-flying tech stocks headquartered in Seattle saw their stock values explode, enriching workers who had equity via employee ESPP plans or specialty bonuses. The downsizing of tech giants has impacted housing demand significantly, leading to a situation not seen since the Great Recession in 2008. Seattle has witnessed a surge in the number of tech company layoffs, which is nearing levels from 2008, leading to a decline in housing prices. There's been a notable increase in inventory levels, and price drops are becoming a regular occurrence in the housing market. The same trend is visible in other tech cities such as San Francisco, Austin, Portland, and Phoenix, with inventory levels jumping by significant percentages. This pattern is evident in expensive cities, especially those with a heavy tech presence, and it is typically a sign of a forthcoming massive downturn. Therefore, the surge in inventory levels is an indicator of an impending downswing in the housing market. Bill McBride's research reveals that throughout history, inventory is a critical indicator of the state of the housing market. By analyzing the relationship between prices and supply, McBride discovered that as the number of homes available for sale increases, there is a greater likelihood of prices dropping. For instance, when there is a record-breaking 12 months of inventory, it tends to result in significant decreases in the nationally tracked Case-Shiller index. However, many analysts encounter issues with this chart because they tend to be too optimistic in their predictions. Due to the events of 2020 and the actions taken by the Federal Reserve, the chart's reliability is diminishing, leading to more extreme and unpredictable market movements. As a result, the housing market is experiencing more severe crashes than previously believed. To illustrate this point, the current housing inventory level is at 3.3 months, which is expected to rise to 3.5 in the next report. Historically, since 1999, there has never been a negative print in prices when inventory levels reach this point. Nevertheless, the Case-Shiller is already showing a downward trend. In September, it decreased by 1%, and it is anticipated that the October number will be similar or worse. This indicates that the subsequent print will result in astonishing outliers being added to this chart. In light of all of this, it is safe to declare that despite the fact that inventory levels give the impression of being relatively low, we are witnessing significant price reductions on a nationwide level. This has never happened before, and my theory is that the market is moving so quickly that the numbers gathered by the Case-Shiller Index and the National Association of Realtors are not able to keep up with it and effectively measure what is happening on the ground. This is something that has never been seen before, and if this type of downward trend can be seen on a national basis, then we can only picture the carnage that is taking place in the overvalued cities that we discussed previously. We learned during the most recent recession that specific markets are capable of experiencing significantly more severe downturns than are reflected in national statistics. We are already seeing this play out in multiple markets that we discussed today, and as the flow of data continues, we will get a fuller picture later this year, and hopefully have a better understanding of just how severe this situation will grow. Thank you for watching this video about the current state of the housing market in Washington and across the United States. It's clear that the market is going through a period of significant upheaval, with some regions experiencing much more severe crashes than others. As we've seen, inventory levels are a critical indicator of the state of the housing market, and with the current level at 3.3 months, we are already witnessing significant price reductions on a nationwide level. This has never happened before, and we can only imagine the carnage taking place in overvalued cities. So, what does this mean for investors? As we discussed earlier, it's never been more challenging or essential to restructure one's portfolio, but there are alternatives that can provide a reasonable solution, such as alternative asset classes like fine art. Platforms like Masterworks offer access to top alternative asset classes, and investing in fine art is a natural inflation hedge. It's something to consider as we navigate these uncertain times. Thank you for watching this video on the Washington housing market crash. Don't forget to like and subscribe for more informative content.